The key with something like tariffs and Liberation Day is you have to plan ahead. You can't come into Liberation Day, wait for the headline, and then decide, oh, that was worse than I thought. Now I need to actually adjust my portfolio. It's too late at that point. Liquidity dries up. You see spreads go wider, both in terms of credit spreads and trading spreads on those securities. So for us, many months in advance, we're thinking of where these industries or which industries are going to be more impacted. And, you start to rotate your portfolio in advance of that.
Today, I'm speaking to Wayne Dahl, Managing Director and Co-Portfolio Manager at Oaktree. Wayne, it is so great to have you on Monetary Matters. Welcome.
Thank you, Jack. It's a pleasure to be here.
Wayne, we're going to be talking about all things credit, very, very large market. So you're dealing in things like loans, high yield bonds, asset-backed securities, the CMBS market, some CLOs, some private credit. That entire universe, how are you judging the risks and rewards in that space?
I think the first thing that comes to mind when thinking about those asset classes in particular is the attractive yields that they offer. We hear a lot about spreads. Are spreads too tight? Are you getting compensated for risk? But again, spread is not what drives your total return. That's the yield, the spread plus the underlying interest rate. And in all those asset classes you just listed, bonds, loans, structured assets, private credit, there are very attractive yields. I think that's the first thing. And the way that kind of, we'll call it sub-investment grade fixed income fits into portfolios in an environment that could see some volatility pick up for equities, that seems, like a pretty attractive opportunity to earn a, we'll call it 7 to 9-ish% yield across those spaces. I think when I look at this year, and maybe we'll kind of back up from more than 2025, maybe back the last kind of 9 to 12 months, I would characterize it as kind of a period of almost convergence. After 2022 and into 2023, you certainly had some of those asset classes that were maybe slightly more dislocated than others, offered slightly higher yields relative to their risk. Now, I think more of those asset classes are fairly priced. Some maybe even, slightly on the rich side, but you're seeing less dispersion, I think, on a broad basis across those asset classes at this point in time.
Thank you, Wayne. And I should note that even though you said some credit asset spreads might be excessively tight, that everything in finance is relative. So you're comparing it to a stock market that also has a very, very high multiples. Every risk asset is quite rich at this point. Within the world of credit, where are you finding bargains, and where are you, let's say, underweighting because you're finding fewer and fewer bargains because the spread is so tight?
Yeah, and maybe just a quick comment on your statement about equity markets. I mean, that is something we hear a lot from investors. Oh, why should I put money in high yield bonds? The spreads are too tight. And my response is often, what event are you considering that will, move those spreads wider? And then think about what impact will that have on, to your point, high multiple equities. And usually it's an event that will be negative for both and probably more negative for equity markets. So I think that has been a factor that has kind of kept a lot of investors in this kind of fixed income asset class. But you're right, some offer more value than others today. I mean, I think in the high yield bond market, there's certain parts of that market, the higher quality double B part of the market, even some single Bs where you're seeing spreads in the low 200s. You're seeing yields around 6% or even lower. Doesn't sound like the most exciting, opportunity. Now, when you're willing to dig in and be involved in active management, find these good quality single B companies still paying those attractive yields, you can find value there. But you probably have to be a little more careful. I think across structured credit, you can still find some very attractive value. Certain parts of the CLO capital structure offer more value than others. Double Bs in particular, I think still are a pretty compelling opportunity, especially in a multi-asset portfolio where you're, kind of diversifying across the different assets. And I think residential mortgage-backed securities in the US, particularly non-agency, are good sources of value. May not be the highest headline yield, but when you factor in, everything that drives the value in those assets, attractive fundamentals, attractive loan to values, the possibility of a pickup in prepayments. I think there you're seeing some pretty good value. And maybe last, which I'm sure you would have gotten to, is there's been some pretty good value in Europe of late on the margin, both in loans, both in high yield bonds. As you know, as investors that hedge that currency risk, you're adding some pretty attractive carry. So, again, I think each asset class has its compelling opportunities. Some just a little better than others.
And Wayne, in the upper part of the high yield market, so triple B, double B, single B, you said some spreads are as low as 2%. That sounds awfully low to me. And is it almost in the high yield market where you and other folks at Oaktree and other folks at the good credit shops would never really buy this, other than the fact that if you don't buy it, you're going to be drastically underweight one particular rating class, or that there's just so much money flooding into the more passive products, not active managed, such as you and Oaktree? That's the reason that the spreads are so low. Or is it could you actually make the case that, hey, the fundamentals in terms of the covenants, in terms of the leverage, in terms of the favorable macro outlook for the entire economy and for credit is such that a 2% option adjusted spread actually does make sense?
I think in some ways, like each of those statements you made are true. Again, if your target yield is maybe closer to 6%, and that's what you're comfortable with, then those, to your point, high quality double B assets may be exactly what you're looking for. In addition, you may want something with a little bit more yield and maybe just a little bit more, say, duration than your kind of average high yield bond. So that could be attractive for somebody. Here for us today in the portfolios that we manage, we're looking for a little bit higher yield. And again, we feel like with the expertise in fundamental credit underwriting, we're comfortable kind of taking that additional risk to get that extra yield. And we feel like we're also being rewarded for that. So, again, to your point, I mean, I think depending on a lot of different investor needs, those different parts of that high yield kind of rating spectrum may be more attractive or less attractive than others.
That makes sense. And what about the lower rated parts, those triple C rated and below? Can you talk about the dispersion between the different, whether you want to talk about ratings or just credit quality? Because I'm looking at the triple C spread of an index, and it doesn't appear to have returned to the January lows, whereas the overall index actually somewhat appears to have done that.
I think that is a great observation. And coming again kind of out of that spread widening event we saw in 2022, and you've kind of had a real significant rebound over the next kind of 2+ years, where investing in some of the riskier credits was, in hindsight, like the right thing to do. I think this year has highlighted the fact that maybe that trade has kind of run its course, and maybe some of these like companies that remain triple C have not been able to be upgraded really do have longer term problems. They really do have capital structures that probably need eventually some sort of solution. And really, looking at triple C's is one thing. You're going to look at an average spread in the kind of mid 800s, maybe low 900s. But if you kind of divide maybe that category a little bit further, where you say, let me look at the spreads that are really kind of 1,000 basis points and higher, and those 1,000 and lower, now you really even see a more kind of stark dispersion across those cohorts, where the above 1,000 are again just underperforming in this type of environment of uncertainty. So again, probably not the best place to want to take that kind of risk unless you're fully ready to accept what comes along with that.
And where would you say, of the many different asset classes, what would you say is the one that offers the best risk reward right now?
There's a couple that stand out. I mean, I did mention CLOs up front. I mean, I think a double B CLO where you have a pretty attractive spread, kind of anywhere from low to mid to high 500s, that's pretty good in this kind of environment. Your default risk, historically has been relatively low, almost near zero. So, are you willing to, take an asset that carries very well, that serves a good multi-asset portfolio, serves a good foundation there? I'm going to earn that attractive income. That I think is one of still the more, relatively attractive assets. And again, I think residential, I mentioned that up front. I
Mhm.
mean, I think what's great about RMBS today is depending on the vintage, depending on the coupon in the non-agency space, you can buy RMBS securities that have, low to mid sevens yields, and they're today prepaying at very, very low rates. If you see a shift in the interest rate backdrop, some of these people that have taken out mortgages in the last few years start to refinance those. You start to get paid back. There's kind of an acceleration in your return as those securities pull to par faster. So again, an asset that really does have very good fundamentals. I mean, with house prices up kind of 50% in the last few years, these loan to values are anywhere from 60 to 70%, which again gives you a lot of cushion. Delinquency rates are low. You don't see the lending to lower quality borrowers like you did pre 2008. So I think, again, to your point, on a risk adjusted basis, that asset class I think looks very attractive today.
All right, so CLOs and then also mortgage-backed securities. What about this magical phrase of two words called private credit, which of course existed for a long time, but it's kind of become this meme where everyone is talking about it, and it includes different things. How would you define private credit? My first question, and secondly, how are you appraising the risk and reward in that asset class?
Yeah, I mean, you're right. Private credit has certainly, been the one of the favorite asset classes for the last several years, growing, at a rapid pace. I mean, people are in love with the fact that I can buy an asset. There's no volatility in the price, and I earn historically a 9 to 11% kind of return or yield on those assets. I think you got to remember private credit is kind of an overarching term that will pick up a lot of different assets. So within private credit, obviously the largest part of that market is direct lending, the part of the credit market that would compete with the broadly syndicated loan. But in addition to that part, you have asset-backed finance, which has been growing and growing as banks have been looking to, kind of offload some of their risks and put those into the hands of sophisticated investors that understand that. You have lending in the real estate space as well. So there are definitely a lot of options, asset-backed deals, consumer lending, things like aircraft, autos, all these in the ABF space are creeping up. And there, I think you're seeing some kind of dispersion across the opportunities. I think direct lending has certainly seen spreads compress, still at a premium. I think it still makes sense in a portfolio. But as far as attractiveness and outright yields and maybe risk adjusted opportunities, I think areas like asset backed finance in that private credit space are probably a little more attractive today. Again, especially in a multi asset portfolio that can decide where it wants to invest at any given time.
How do you view the remarkable growth of this asset class in terms of assets under management? And do you think that the growth is sustainable?
I will speak from kind of my view in my world, what I'll say as a portfolio manager of a multi-asset credit portfolio. So I mean, we will use private credit in all of its forms, direct lending, ABF, real estate private credit. We'll use all those at various times when they're attractive. And I think private credit has a place in those portfolios. And will it continue to grow at the pace? For me, it doesn't really, it's not that it doesn't matter, but it's maybe not the most important fact. What I do think you have to recognize is that, private credit has given the markets, a great alternative for financing. There's Private credit might get a bad reputation more recently that, oh, there's all these, risky companies that are hidden in these kind of non-mark to market strategies. But at the same time, private credit is an asset class that's managed by sophisticated investors. Capital is locked up. People understand the illiquidity, its ability to really kind of absorb risk that other parts of the market have proven historically that they maybe can't, we'll say, stomach. Private credit's been a real benefit. Look at the syndicated loan market, look at the high yield bond market. You've definitely seen a lot of names over the last few years kind of move out into that private credit market as a good source of financing. And, many of these are good companies that, whether, the rise in interest rates gave them challenges with their balance sheets, they needed more sophisticated solutions. The syndicated loan market, largely held by CLOs, might not be the best kind of holder of those loans. Now we again kind of have that better market. So again, I think overall, it has really been a service to the market, provided a lot of companies with financing. And like any market, some loans will will go bad. Some loans probably shouldn't have been made. But I think in many cases, the right people are behind those loans and kind of know what to expect.
And Wayne, in that area of, I guess, direct lending, just the performance has obviously been very good. When anytime someone talks about spreads going down, that means that if you have owned the loan before the spread went down, you've made
That's
money.
right.
Just can you give some numbers or some color on just how well these loans have performed? Where was that spread between private credit and the broadly syndicated loan market, or private credit and the high yield bond market? Pick your comparison, let's say in 2023, and where is it now? And how much of that gap has been filled?
If you look at the kind of broadly syndicated loan market and say, spreads today are in the low 400s, and private credit today is going to be in maybe the high 400s, low 500s, you might say, well, that doesn't look like a very compelling opportunity. There's only 100 and low 100s kind of basis point spread. Again, back a couple of years ago, to your point, those private credit spreads would have been 650, 700. Loans would have been 450, kind of 500. But the better way to look at that today is to say, where would I buy a good kind of attractive performing kind of private credit loan, that kind of low 500s, high 400s, versus a good single B company that's not under stress in the syndicated loan market? That's actually in the low 300s, despite that kind of index showing you those low 400s. So I think that spread is probably a little wider than the just looking at the broad market would make it appear. So, you're still talking kind of 150 plus basis points. So again, I think you're still, again, finding opportunities, especially if you're flexible and you can go beyond just your kind of first lien kind of sponsor-backed lending into, non-sponsor deals, sector-specific deals like a life sciences, or again, even to some of these asset-backed finance deals. So I think private credit as an asset class still offers a pretty attractive spread to, let's say, the performing non-stressed cohort of kind of that bond and loan market.
And how would you characterize the extent to which, if at all, in the market of private credit and direct lending, there is the reach for yield? If people are making those loans to those companies that people are relatively confident or they're good for it. Back 2 years ago, if you had CEOs of alternative asset management firms, of CIOs, go on TV and say, "Oh, I can get 15% with this loan," they likely can't get 15% with that loan anymore. So in order to get a 12, 13, 14, 15%, they might have to be taking on more and more credit risk. To what degree at all are you seeing that?
No, you're definitely right. The yields available have certainly come down. And again, if you want to kind of stay out of the riskiest parts of that market, you're going to have to kind of accept where those levels are. I think people are maybe a little bit careful about taking a lot of risk now. And your earlier question about the high yield bond market and how finally in the year 2025, investors are being a little bit more careful about some of these riskier names. They're not willing to just pile in expecting, hey, this is your point, of 12% yield, spread's going to come down. I mean, people are definitely more hip to the game of there could be an actual restructuring within this deal, a liability management exercise, which obviously has been the kind of buzzword of the last kind of 12 months, and I think it'll continue to be. So again, I don't think your kind of everyday investors really wanting to reach for that. And I don't think they need to. You're still getting paid quite well to not kind of take that risk. Leave that risk for those who are, kind of capable and have the teams and have the ability to deal with that sort of situation.
And earlier you referenced sponsor. That's basically a private equity company who it would be borrowing money, as opposed to a non-sponsored deal would be a company that's not owned by private equity. Can you characterize the differences between those two markets? I know just from an IMF report, I assume that this is correct because it's from the IMF, that the sponsor deals generally had a lower default rate than non-sponsored deals. If that is the case, why is that the case? Is it generally sort of reputational that giant alternative asset management firm A doesn't want to be known as someone who doesn't pay back their loans, or is it for some other reasons? And also, could you just characterize how you're assessing credit risk within those two markets?
I definitely think there's the likelihood of more complexity in those kind of non-sponsor deals. The business itself might have some, sort of complexity. Again, like life sciences is a good example where not everyone is, maybe has the expertise to underwrite, what that business is doing or understand, why they want this form of lending, versus say like raising more equity. So I think that's one. The other factor is that these deals just have less potential buyers in them. You're typically not going to get them done maybe as fast as a sponsored deal where a lot of kind of supply is and demand are there for both of those deals. And again, you get a little bit of a complexity premium. You get a kind of a, I'm trying to think of the right term. I mean, where you kind of have to do your homework. You have to have a good sourcing team that's kind of finding these, getting in front of the right, direct companies or banking relationships to kind of uncover these types of deals. And so it's just a little bit more difficult and challenging than your kind of first lien kind of sponsor deals where everyone's kind of in the flow and following those. And so again, I think, again, from my perspective in a portfolio where I can choose across many different asset classes, once again, it's just another great way to kind of diversify your risk and seems very attractive in that kind of opportunity or that kind of portfolio.
And you talked about life sciences. What are some of the biggest sectors, however you want to divide them, that are the borrowers in this market?
So that's probably one of the largest areas that we invest in here in that market and have a team that's been doing that for many, many years. And so, I mean, that's an area where, for me as a portfolio manager, I'm certainly willing to ride alongside these portfolio managers and sourcing team that, knows that market. So that would certainly be from my perspective, the one that fits best.
Okay, interesting. A lot of life sciences. And could you also just say within the broader credit ecosystem, which sectors are some of the biggest borrowers? I think a lot of people, maybe myself included, have a sense that the technology is for equity investing, and that the bond investors they're lending to steel plants and to factories and the like. But it's my sense that that's not really the case anymore, and technology sectors are a very large borrower. So yeah, just talk about the different sectors as well as alternative forms of collateral. If you're lending with steel mill, that you have a lot of plant and equipment, you have a lot of steel inventory that is collateral. What is your collateral and your margin of safety and your protection with newer industries like technology?
Yeah, you're right. I mean, the software kind of industry in general has become one of the largest or the largest, sector in the loan market and probably in the direct lending market as well. I think it's a good target for kind of private equity companies to, sponsors to buy those businesses. You probably have very good kind of reoccurring revenues, which are going to kind of be your collateral support for those kind of deals. In many cases, you may have companies that have, some sort of kind of barrier to entry to their business, or they have long-term government contracts that you have kind of a locked-in buyer. So, and maybe the third thing is they tend to be a little bit less cyclical. Like if you need that software to kind of run your business, run your university, run your whatever it is, you're going to always kind of keep buying that and prioritizing that. In addition, is what we've seen more recently, even around things like tariffs. In many cases, these are largely domestic industries that have largely domestic, kind of client bases. So, again, you're kind of buying an asset that may be, immune to some of those tariffs. But I think to your point, I think that's also maybe a distinction that's growing between the high yield bond market and say the syndicated loan market or even direct lending market is historically that loan and bond market shared a lot of issuers. You had an issuer come to market, they would issue a first lien loan, they would issue an unsecured bond, and then they would have more, junior parts of their capital structure and equity. And that was the way a lot of that market was. Over the last few years, you've seen the loan market become much more weighted towards those private equity sponsored deals where the loan becomes the only security in the capital structure. And so you do have a lot of loans in areas like software versus the high yield market where you haven't seen that significant growth in those kind of industries. Software is not the largest industry. And to your point, you are financing more of your kind of traditional businesses, whether that's industrial, that's energy, that's kind of all those more consumer staples, packaging, kind of your boring businesses in healthcare. It's not your kind of high flying, high tech, healthcare research. It's more of your hospitals, your care facilities, like these kind of more less cyclical businesses that are kind of a little more traditional. So I think that's one thing to bear in mind as well when you kind of look at those two markets. You're definitely getting exposure to kind of different underlying credit dynamics.
And you mentioned tariffs. How were you thinking about tariffs as a risk to the world of credit, the broad world of credit? How are you thinking about it on or around Liberation Day when the stock market crashed and the high yield market crashed as well, although maybe slightly less so? And then how are you thinking about it now?
Yeah, maybe crash is a little bit harsh for the high yield market, especially compared to equities. I think the kind of peak to trough was maybe around 3% down versus almost 20. So I think high yield held in reasonably well. But I think the key with something like tariffs and Liberation Day is you have to plan ahead. You can't come into Liberation Day, wait for the headline, and then decide, oh, that was worse than I thought. Now I need to actually adjust my portfolio. It's too late at that point. Liquidity, dries up. You see spreads go wider, both in terms of credit spreads and trading spreads on those securities. So for us, many months in advance, we're thinking of, if President Trump wins re-election, and he's talked about tariffs his whole first term and his, many times on the campaign trail, you have to start thinking, where are these industries or which industries are going to be more impacted, which parts of consumption from the consumer space will be more impacted. And, you start to rotate your portfolio in advance of that. And I think one of the great things one of the real opportunities we had kind of earlier in the year and even late last year is that so much of the market was trading with little distinction between risk. You could say, like, not really trying to price the difference between, what would ultimately be a tariff sensitive name like an auto parts dealer versus, a non-tariff sector name, like, maybe something in healthcare. You could rotate for, again, almost no give up. And that was really the focus. I mean, I don't think we went into an investment committee meeting for months where Bruce Karsh, our CIO, who leads these committees, wasn't asking the various portfolio managers and analysts, what sectors are you worried about? Where are you seeing the potential for a tariff impact? This was a question being asked months before April 2nd.
And that dispersion between companies in industries that would suffer from tariffs and
or lack of dispersion.
Yeah. That lack of dispersion between industries that would suffer from tariffs and industries that would suffer a lot less from tariffs. How has you seen that? Have you seen that dispersion widen at all over the time when risk assets have rallied and tariff fears have largely fled the market? Because I know in equities, I don't think you saw a ton of dispersion either. I think it's pretty much the same story.
Yeah, no, you're right. I mean, a lot of that real risk was pretty short lived. And, I think people, were very quick to, kind of ignore the potential for tariff risk, thinking, well, these are just negotiating tactics. A big number is going to get thrown out there, but we all know it'll end up being a small number. And I think in aggregate, both in the credit markets, in the broader economy, I think that's an area that people are underappreciating, that, something like tariffs, if, we've settled at kind of this, call it 13 to 15% of our imports sitting with a tariff. That's up from, low twos at the start of the year. Like that's a pretty significant increase. I mean, we know from the numbers that we see on the daily treasury statement that we're kind of annualizing somewhere at around a 300 billion rate. I mean, that's a pretty substantial tax that somebody has to pay. One of three people: the exporter, the person importing, or the ultimately the consumer who's consuming that. And we know, there's a mix of how that's, dispersed across those three. But again, like somebody has to pay that bill that did not exist before. So, I think we're probably in for some some greater dispersion maybe ahead, kind of, even if we just stay where we are, as we kind of see how that kind of knock on effect, or we really call it like increased tariff impact, feeds into the underlying fundamentals of these companies, and again, in consumers own pocketbooks.
And have you seen tariffs impact fundamentals? It's very hard with the macroeconomic data because the jobs number, it was still strong. There's some adjustment. Who knows? Same with inflation. But on the individual portfolio company level, have you seen anything saying, this company, it imports a lot of steel cans from China, and they used to be moving X, but actually in the month of July or June, it was slightly less. Have you seen any of that at all?
We're just starting into second quarter earnings season. I think those are things that people will definitely be really putting a close eye on. Again, like back to that point of like, tariffs definitely went up in April. They didn't maybe go to the peak that people thought, but they went up. And how did that start to feed through? How is that impacting? How is that going to, impact that company's ability to, forecast? Will they stop forecasting? Will they not give projections? So I think, that is something that will stay in the news over the coming weeks. And you're right in the fact that like it's been difficult to, extrapolate that at the broader kind of economic level, because I think we do kind of face this real challenge in broader economic data, that it's very hard to extrapolate, what we saw in the first quarter. I mean, things like durable goods, like there's no doubt that people pulled their purchases forward. I mean, you saw, durable goods, which is a large part of that is autos, appliances, things like that. They spiked at a 20% annualized rate, over a 3-month period ending in April. I mean, so can I extrapolate that for the rest of the year? Probably not. Your point about jobs, there's just a lot of those kind of indicators that I think are, giving, maybe almost misleading messages, and I think that's going to create, again, in that backdrop of higher tariffs, higher, I hate to use the term uncertainty because everybody kind of says that, but in some places there is, and what I would say maybe the uncertainty is uncertainty, and how to think about the second half in, kind of conjunction with what we just experienced in the first half.
And how are you thinking about how tariffs on these cyclical import sensitive industries is going to impact the credits of those companies, the fundamental value, the trading value? Is it going to be a 10 basis point widening versus a scenario where there's no tariffs? Is it a 90, 190? I know you can't really answer that question. It's impossible. But how are you thinking about that? And how are you gathering the data that is just about to come in right now?
That is one of the tough jobs to do. I think, one thing you can do is, kind of remove yourself from some of the most uncertain risks. If you're not sure if it's going to be a 10 or going to be 100, maybe that's a name, maybe that's a sector that you can choose to underweight versus the broader market. And I think, that is one advantage of an actively managed portfolio. You can focus more on, companies that have a largely domestic base. To your point, they don't import as much. Again, like we've seen over the last few months, like a 50% tariff here, a 30% tariff there, it's off the next month. I mean, you can choose to just say, hey, I'm going to wait. If that doesn't come, I don't get that big spread widening in that industry, I'm still investing in something that kind of meets my overall kind of portfolio objectives. If it does, I've got the underwriting on the company. Here's a level that I may be interested in buying, and I put that down and I wait for that. So you just can't compromise. I think that's the one key thing for us as, and again, like bottom up credit investors, that we will never make a decision that is not kind of supported by the credit fundamentals. And if that includes a very high level of uncertainty, we can move on. There's plenty of places to invest. So you have to follow it. We have a team of analysts that will track that, record that, to your point, try and assess that. But we're going to go with the names and the companies that we know are going to be most likely to pay us back.
I want to ask you about data and transparency between the companies or sponsors that you lend to and you. I've actually spoken with two regulators or former regulators, both about private credit, and I wouldn't say they were like terribly concerned about this is going to be 2008, but one thing that I got from them both, particularly this the general secretary of the Financial Stability Board, is that they are quite noticing that there is a lack of data that, hey, we're the Federal Reserve, we're supposed to have insight into all of this stuff, and we really don't. But so you and Oaktree are obviously in that world. What's the level of data and transparency that you can get from the companies that you lend to? Like, I presume it's definitely more than I can. Like, I and non-participants in that world really have almost nothing. But when you lend to a company, how are you assessing that? How are you gathering the data? Are you getting the data at the same time the sponsor gets it? And just that the general transparency in that market.
I mean, look, you're definitely getting enough of that data to make that credit decision. I mean, it's, usually in these deals, there may be only a handful of lenders coming there, and you're going to kind of get that information. Now, again, does that always mean it's perfect? Can you still predict the potential behavior of that underlying sponsor? You can't always do that, but you can certainly, you're not missing data that you need to kind of make that credit decision. And again, sometimes you may be conservative with that decision. You may think you're in an environment where, I'm going to wait till the next potential deal because this just kind of doesn't meet my credit underwriting standards today. And I think that's what you've seen in these very competitive markets when a lot of capital comes in and you're kind of forced to put that capital to work. Some people will be, kind of more willing to lend at, tighter spreads and easier conditions. Whereas, you have to kind of, set your limits. What are you willing to live without when it comes to covenant structures, protections? That's all stuff that can be very, very important down the road. And I think in the space of private credit, that's what a lot of lenders are kind of realizing now is that, hey, I didn't have enough protections at the beginning of this deal, and somebody came in and stripped assets and moved them to a new box and issued a new security that's senior to what I thought was my first lien. Those are the opportunities that we also don't want to miss out on. So it's good to be in the flow of those deals. It's good to know where and when you're passing and when you may be able to come back. Again, as an investor at Oaktree that focuses on, some of these, more stress situations, it's just good to kind of stay in the flow of that. So you're always kind of ready to pounce when your opportunity comes up.
Thank you, Wayne. That's so interesting. I think what you're describing is the somewhat dramatic phrase of creditor on creditor violence. When we spoke for the first time in an interview on my old podcast, Forward Guidance, I believe about a year ago, last summer, let's just say it was a year ago, would that so-called creditor on creditor violence, is it higher now than it was a year ago when we spoke on Forward Guidance?
Well, I think by higher, if you mean is the volume greater. Yes, I think it's more transparent. I think people recognize it more, people expect it more, but it's definitely going to continue. There are just too many companies, too many balance sheets, too much lending out there to people who are going to need capital solutions. Now, I think one thing to remember is that if you hear somebody talk about a number, let's say X number of $billion, I mean, the syndicated loan market is a $1.4 trillion market. So you could say 10% of that market's 140 billion. Remember, there's still 90% of that market that probably won't have to go through one of those exercises. So just you have to recognize that risk is there. You have to know how to underwrite and prevent yourself from investing in those risks. But it doesn't mean that I shouldn't be investing in those markets. It doesn't mean I shouldn't be in the loan market as a performing credit investor. It doesn't mean I shouldn't be in the private credit market as a performing credit investor. I just need to know those risks are out there and how to avoid them. But there's a lot of opportunities out there, a lot that are not going to go through those, liability management exercises.
And Wayne, some narrative I've encountered, I'm sure you've encountered it as well, is that because of the US tariff policy, investors around the world are they're either pulling their money, or a less dramatic way to put it is that their net investments is on the margin going to be slightly less US centric than it was before. What, if any, validity are you seeing that in the market?
Yeah, no, that is a very valid question, and there's no doubt that you see that in certain data. I mean, if you look at, kind of broad, kind of foreign holdings of things like dollars, they're way down. I mean, kind of on a percentile basis, they're near the 0th percentile over the last several years, and people aren't buying. Like, this was kind of one of my peak concerns early on in April. I thought, oh no, the US has been this place where everybody puts capital. Like, think about trading and think about trade deficits. Like, this is what I've always kind of found weird about, putting on tariffs and trying to collapse the trade deficits. It's like you automatically lock somebody out that was going to have to buy US assets. They were going to have to put those dollars back to work in treasuries, in bonds, in other, in other securities and equities, and you're going to reduce that. Why would you want to do that at a time when we should be welcoming people to buy our assets? So it was a concern that honestly just really hasn't materialized in terms of what you see in the prices. Even from an investor standpoint, I think people still see value. I mean, at the end of the day, the US is just such a very, very, very large market that I think it's very hard to, put a lot of money to work and exclude the US completely from that picture. I mean, I mentioned up at the beginning, like, have there been some marginal, opportunities to invest in Europe over US in fixed income? Yes, there have been. There's been some pretty attractive deals. Their primary markets have seen, a real pickup in activity over the last several weeks, and I think this kind of dynamic is contributing. But again, you haven't really seen, a massive sell-off in US assets because everybody's kind of exiting them. So I think it's something that's real. I do think it's something to kind of watch out for. I haven't really kind of been able to maybe see and feel the impact so far. And this could be another one of those dynamics that, as I mentioned at the beginning, how do I extrapolate the first half into the second half? Is there kind of a delay impact of this into these kind of riskier markets? I'm not sure. But again, so far, there's been plenty of buyers of US credit.
And buyers of US credit from outside the US in particular.
Yeah, and inside the US.
Yeah. How would you describe your participation in the non-US markets? You mentioned Europe. Are there any other centers where you're seeing value? I guess I've interviewed a macro fund manager, and he and his firm were buying, I guess you could call them high yield, like Latin American debt. But I don't know, maybe that market for Oaktree, $200 billion, is simply too small to be involved in any particular scale.
No, as a firm, we're definitely involved in markets around the globe, including some of these emerging market, opportunities. Again, in the kind of multi-asset credit space, we definitely selectively invest in emerging markets and have certainly found value on really almost on a company by company basis. That's kind of how we assess that market relative to developed markets. I mean, and that's kind of how you have to do it today, because there are many, companies in that emerging market kind of corporate bond space that will have yields and spreads similar to what I can buy in a developed market, US or Europe. And so, why would I want to, accept that additional kind of volatility risk or macro risk to get the same yield? But, again, select companies that have good credit profiles in these other kind of EM markets around the world. Yeah, we're absolutely open to have. We have exposure to that in across the strategy. So, nothing's closed. Even certain parts of Asia. I mean, China's a good example where you've seen a lot of stories about, how cheap equities are, in particular in China, and through the convertible bond market, which is also a source of fixed income exposure. you can gain access to some of those companies, and you can gain access to a market, like China, which certainly has been cheap at times over the last year. And, we're able to use that convertible bond market to kind of pick up some of that. So global is certainly, the idea, but there's no doubt that in, kind of sub IG fixed income, US and Europe are going to be the largest places there.
And do you always hedge the currency risk?
We do always hedge the currency risk. And the reason for that is it really does help when you think about relative value. If I'm looking at, again, as we said, I mean, looking at that loan or bond or even, kind of direct lending deal in Europe, if I think about, what I'm going to earn by hedging that currency and I can lock that in today, that helps me really understand what my kind of expected return is. If I don't want to make a call on the currency, I can say, hedged, this is a 9% yield. Equivalent risk in the US is 7.5. That's 150 basis points. That feels like, a great opportunity. Let me lock that hedge in, buy that security. So yes, I think as relative value investors and bottom up investors, hedging the currency is very key in kind of making those decisions.
And so when you're hedging the currency, that means if you're investing in a security that yields far higher than the US dollar assets generally yield, that you're actually your hedging cost would cost. So it would cost you money. So if like you buy
Yeah,
a Brazilian high yield 20%, that means that really if the US base rate is 5%, that you're maybe paying 10% of your hedging cost. So the dollar cost of that is not yielding 20%. But what about
correct.
countries like Japan or China or Europe, where they actually yield lower? So you invest in whatever your yield is, you're hedging back into the dollar actually is a positive carry thing, right? So are
Correct.
you seeing any opportunities there?
Yeah, no, absolutely. I mean, if you look at, kind of, again, to your point, European assets hedge back to dollars, I'm picking up about 250 basis points. I can lock that in for the next 12 months kind of very easily. And, over the last few years, that has been as low as kind of 1.5, bounced around to its 2.5, largely because the ECB has continued to, lower interest rates, and the US had its lowering in late 2024 and has been on pause. So that has grown. And, again, as investors, you can take an opportunity to, again, kind of lock that in. So again, that 5% local yielding investment in Europe becomes roughly a 7.5% yielding investment in US dollars. And you kind of need that framework to, again, kind of assess that relative value.
Earlier, Wayne, you referenced some stat where you said US dollar holdings are way down. Was that a credit specific stat? Or was it from the macro world? What were you citing there?
Yeah, no, yeah, thank you. The stat is, State Street, as a very large custodian, actually measures kind of holdings across its, custodied assets. And, obviously being a very large custody, you can kind of assume that probably other custody held assets are similar. And they kind of track on a 5-year kind of rolling basis percentile ranks for, holdings in various currencies as well as the flows. And right now, over the last 5 years, you're down near the 0th percentile, which means arguably people are very short the US dollar versus where they have been. And a lot of that has come this year. If you kind of go back to even the inauguration of President Trump, that has come down, significantly over that period, and really accelerated in February, when you had that kind of shift towards, hey, in Germany, we're going to spend more on defense spending, bring more money home. You're seeing that. But again, to your earlier point, it hasn't really fed into the markets feeling like we're short on buyers of assets. If that was the case, you probably wouldn't have seen high yield spreads, push back to the, kind of 300 level.
And Wayne, let's go back to the sponsored world talking about private equity. Is one reason why loan spreads are so low, private credit loan spreads are so low as well? Is it because that private equity is having a challenge of selling their assets to a strategic buyer or to another private equity company or to an IPO? And as a result, the demand for new financing is actually lower than the supply of new money coming into the private credit market.
I think you're spot on with that observation, Jack. And I've said this before where you can do the math. You can look at the private equity market and say, hey, there's, X, trillion dollars out there in dry powder. If it was all deployed now, we don't have enough capital in the private credit market or the direct lending market to absorb that. And that's correct. The difference is, to your point, most of that private equity capital is drawdown. They're only going to deploy it when a deal comes to them, whereas a lot of the private credit and direct lending capital is put it in a public or a private BDC right now, and I have to put that money to work. So you get these periods where supply and demand are not in balance, and private credit is kind of forced to maybe deploy more capital than, to your point, private equity is putting out. We know that's going to shift. We saw that shift in 2022 and 2023 when a lot of people kind of paused. Maybe they didn't have the same pace of flows. Maybe they had outflows. So those with capital could really jump in on some very, very attractive deals. But, we've certainly been in a period lately where there's been plenty of capital flow into the private credit space with, to your point, not as much on the supply side for companies, and spreads have certainly compressed as a result.
That's really interesting. So the difference between a drawdown product and an evergreen product.
Yes,
So for example, if there are, I guess, in the world of distressed lending, where Oaktree has been and is still a pioneer. If you raised a fund for distressed lending, you give it to an alternative asset management firm. If they find a deal that they think is a good deal, they're going to lend the money. That is different than and that also happens in the world of private equity. That is different than, I guess, a business development company, or I guess you're referring to some of these newer private credit funds where as soon as the investor gives the fund the money,
that's
boom,
right.
be deployed.
That's right. Yeah, exactly right. I mean, there are certain, again, BDCs that, have to deploy that capital. And when a lot of that capital comes in, you've created a lot of competition for a limited amount of deals.
Yes, and I guess so. In the private equity world, they haven't deployed as much capital, but they're also struggling to exit. How would you characterize your view of the private equity dynamic, as they've been challenging to offload deals at multiples that they would want to do?
The one thing I would say is, and we do know, is that the distributions have not been as high as people have expected. And those distributions are used by a lot of end investors for rebalancing portfolios, putting capital to work in other areas. So, that has caused, I think, some issues for investors in how they kind of create and shape their underlying portfolios, where those assumptions have maybe not worked out as they thought they would. But again, not really a key. Or I'm not the best person to give that that insight on that market.
I gotcha. That makes sense. Well, Wayne, so far we've talked all about credit. What is your view of duration, interest rate exposure? Obviously, it's going to be credit that determines, I guess, the majority of returns. But how are you thinking about just how much interest rate risk you want to have? And are you thinking about inflation? Are you thinking about recession? Are you thinking
Yep.
about the supply and demand of duration within the market? Because I know you have referenced earlier that the high yield market has a lower duration now than it used to.
Yeah, I mean, Jack, I think this is a great question. I think this is a question that everybody does need to think about today. And I think, first of all, what I would say is, I think higher yielding, shorter duration assets are still one of the best places to be. I mean, they just don't have the volatility that you see in other parts of the longer duration part of the market. And the way I think about this is, and maybe this is the math kind of nerd in me, but I think about back in 2021, late 2021. Let's say the high yield bond market had a yield of around 4.5 to 5, and the duration was around 4.5. And for those people who know kind of duration math, if you get a 100 basis point move in rates or spreads, you're going to lose roughly 4.5 points. I would lose 100% of that year's yield if I got that event. If you fast forward to today, do that same math, the yield is between 7 and 8%. The duration is no longer 4.5, it's 3. So now, in that same 100 basis point event, I'm not losing 100% of that year's yield. I'm actually only losing, between 30 and 40% of that yield. And because my coupon is so high, I can make that all back in a 5-month period. So again, like it's very difficult in these kind of higher yielding, shorter duration assets, I think, to have periods really of sustained losses or sustained negative performance, because that coupon just keeps accruing over time. You put the money to work, you go to sleep, you wake up 3 months later, and you've made 180 basis points in coupon carry. And I think that's going to be really important as we go forward from here, because that is, I believe, like insurance or protection against future volatility. And I think the shorter duration is just part of the yield curve that I think we know and understand and can certainly associate with probably Fed policy. Like I can't tell you what's going to drive the 10-year rate. I definitely can't tell you what's going to drive the 30-year rate. So I prefer just to eliminate the risk of being wrong on guessing what drives that and stay focused on credit, which is what you're doing in those kind of higher yielding assets, and leave the interest rate component to somebody who's smarter than me. But I think that kind of high single digit return for short duration assets today is very compelling, and especially, as we said in the beginning, against an equity market that we certainly wouldn't be surprised if we saw some kind of sideways trading in that market without income to kind of support that. So I still think it fits very well in portfolios today, again, if you can align with somebody who's doing the underlying credit work.
And high credit spread, low duration assets, yeah, you're far less vulnerable to interest rate
Yeah.
shocks. Of course, the way that doesn't work, of course, is if you don't get paid back. And one world in which that happens a lot across a lot of bonds and loans is a recession. I don't think a word that I have maybe mentioned at all during this interview.
Yeah.
Wayne, I know the macro economists who've been predicting a recession. Literally, people have been predicting this for over 3 years now, and
Yeah.
it hasn't yet happened. So I understand if you and other folks in the credit world might say, you might be a little bit a nerd to people talking about a recession, and you might not take it as seriously. But how are you taking that serious, that risk, as you look across the environment?
First of all, I mean, you're right. A recession call has been made, I think, every year since 2022, and it's yet to appear. It's hard to imagine that we're not getting closer to some sort of kind of slower economic backdrop. Maybe some of the components of the big beautiful bill that we just saw passed will, kind of stall that a little bit. I mean, things like just something as simple as businesses being able to do upfront depreciation more than they were in the past. Like that could be a real kind of spending boost that we'll see early in 2026. Some of the other incremental tax breaks beyond the 2017 could provide kind of an upstart to that. But we're also hanging on a labor market that has continued to kind of slow down, and you really have to stay on top of your companies and how those fundamentals are trending, and that's the best thing we can do. And I think the other factor is diversification. I mean, we talked about residential mortgage-backed securities. Again, very strong fundamentals right at a time when you might want to be deploying capital in other parts of the market. If prepayments pick up and I get paid back quicker in a multi-asset portfolio, now I have dollars that I can actually put to work somewhere else. If you look at some of the aspects of commercial mortgage-backed securities, which we haven't talked a lot about, in a way, some of the assets in that market, they've already had their recession, so to speak. I mean, multifamily is marked down between 20 and 30%. So new lending to financing in those kind of assets, you've kind of already seen that adjustment, and it's a downdraft in rates in a recession is probably a benefit to some of those assets. So again, I think diversifying across kind of more assets that have different kind of risk drivers, and especially assets that can generate cash when you need it most. And importantly, having dry powder. Nothing's in an environment where, high quality IG assets, investment grade assets that are also pretty short duration, generating around 5%. That's not bad if I kind of want to keep some capital in a rainy day fund maybe against some higher yielding assets like BB CLOs we mentioned in the very beginning. Put that all together in a portfolio. I think, again, are you going to be recession proof? No, not perfectly on a day over day basis, but I think that's a portfolio that is set up, number one, to carry very well. So if nothing happens, I earn a great yield, I earn a great income. And number two, I've got enough diversified kind of risk drivers that I certainly won't feel the kind of maximum pain that maybe any individual asset class will feel. So I think portfolio construction and these kind of portfolios is more important today than it has been in the past, where you could just kind of throw a dart at the board, find that kind of 9-10% yielding investment and sit on it. We're in a different world today, and I think good portfolio management construction is important. And maybe one of the kind of final things to say is, to quote our CIO Bruce Karsh again, he always says, "The credit is the only thing that matters at the end of the day. You get the credit right, you've earned the yield that you signed up for." And that's the way we're kind of looking at these kind of fixed income assets today. Is we like the yield, we want to keep the yield. We want to avoid defaults and losses and deliver that return to our investors.
Thank you, Wayne. Final question. You mentioned the commercial mortgage-backed security market. As someone in the equity market, I've been hearing all across this commercial real estate doom loop that I haven't really observed, with the exception of maybe one New York bank that changed its name recently. I haven't really seen it much in the banks that do CRE lending. And that bank, by the way, it was mostly because of rent control, not because of some recession or some
Yep.
people not going back to the office. You did mention that are you investing in the actual loans, which I know are quite, sometimes quite illiquid, or the tranches of the commercial mortgage-backed security market? And also, you did mention you saw some deterioration in that pricing. I mean, have you been investing in it, and are you seeing attractive yields there?
Yeah, I mean, primarily for the area I'm investing in, we are investing in those commercial mortgage-backed securities, so various tranches, BB, BBB rated tranches, depending on the asset. And again, you have to be choosy. There's no doubt that there is, again, I mean, people have called for that kind of tail event for the last couple of years too, and you've talked about that with some other guests as well. And maybe we haven't experienced that, but what I can say is, just like we said with the loan market, the private credit market, you can always pick out aspects of the markets that are going to be under stress, are going to see defaults and losses, but there's still a big part of that market that's very investable and attractive. And we're seeing that today in the commercial mortgage-backed security market. Not every asset you'd want to own, but certainly when you invest in these commercial mortgage-backed securities that are built around single assets, or even a pool of assets by a single borrower, that's where you can really kind of understand what you own and be comfortable with that risk. And there's still compelling opportunities despite, a sizable overhang in certain parts of that market. There's no doubt that we have not seen or heard the end of the, kind of stress in the office market, but that doesn't mean that all office assets are bad. That doesn't mean that you would not invest in a single office asset. Some are attractive. Some are even being priced today as buildings are refinancing in very attractive areas of New York City. So you have to have your eye on kind of the underlying fundamentals. You have to pick your spots, but there are opportunities there that are attractive and relatively priced relatively well for the risk.
Very interesting. Wayne, thanks so much for taking us on a tour of the world of credits. Really appreciate everyone listening to this. Leave a rating and review on Apple Podcasts and Spotify. It helps the show. Also, of course, subscribe to the Monetary Matters Network on YouTube. Thank you.
Thank you, Jack. Appreciate it.
Thank you. Just close the door.